All right, well, let's get started with today's first session. I'm pleased to introduce our speaker for today's first session, David Bullock, who's our state and local government industry leader and partner here at MGO. David, over to you.
Great, thanks, team. Um, First of all, I just wanted to say thank you for attending our client training today. Um, we've been doing this since 2005, so that's over 20 years of continuous annual trainings. I would say that just a little bit of history. We used to do these live in person, and occasionally some of my clients will say we miss the days of getting together. But it was a heavy lift. It was a lot of time and effort to plan and coordinate and deliver training to different locations multiple times a year. And during the pandemic, we kind of switched to this virtual platform, and it's really allowed us to expand our capabilities, focus more on a higher quality training, and be consistent with that, and allow much more people to participate. And we have a record number of people participating or registered this year, almost 2,000 people. So we just really appreciate the confidence you have in MGO to deliver this training. So this first session is really going to be a focus on current GASB standards. We're going to do a deep dive on 103 specifically, just because it's a pretty meaty standard, so to speak, and could be pretty significant to your organization. The good thing is it's not a big change in maybe accounting and measurements. I mean, if you think about some of the recent standards, pension and OPEB was pretty significant. And then we went into all the leases and subscriptions, triple Ps, maybe even the compensated absences. Here, these were accounting changes, calculations, maybe using present value on some of those calculations, considering new terms like more likely than not, and really changing the numbers and creating additional effort to account for things differently than in the past. 103 doesn't really change the accounting of anything. It changes, what it does change though is the presentation and classification. So we're going to get into that. So we're going to focus the first 1 through 5 is all about GASB 103, and that's the deeper dive. And then we're going to cover GASB 104 and the 2025-1 implementation guide. So those are all due right now. Those are kind of the current standards to implement. And then we're going to take a look at GASB 105, which for most governments will be something applicable next year on subsequent events. And then we're going to talk about some current GASB projects. So that's the focus of today's session. Oh, we're already at our first polling question.
Yes, let me get that. So for your first poll question, I just opened it. You should have heard the chime. Again, I see the answers coming in. Is this your first time attending SLGU? Yes. I can't remember, or no, I've attended before. And I see some in our Q&A. Again, that is MGO. You can see it at the bottom of the screen, mgocpa.cnf.io. I'm going to leave this open. Dave, you can keep on going.
Okay, great. So this is a slide I like to do each year for the applicable standards. I like to remove the standards that have been implemented, and it's nice to see this list actually getting smaller. It feels like we've been implementing a lot of standards lately. And if you think about, in the pandemic, when COVID first happened in 2020, GASB kind of extended the due dates of those implementations. And so we kind of had, coming out of the COVID kind of break, if you will, in 2020, in 21, we had a lot of standards to kind of catch up on. I mean, it feels like we've been at least implementing, 3 to 5 standards a year over the years, and it's slowed down a little bit the last 2 years. It hasn't been too significant. GASB 100 wasn't that big a deal. I think it was more about providing clarification on how you present restatements. And then last year was the compensated absences. So if we look at what's here now, it's not that significant. We have GASB 103, which is what we're going to talk about next, and that's the financial reporting model improvements. disclosure of certain capital assets. So those are the two required to be implemented this year, two statements. And then we have subsequent events that's required next year. The implementation guide for 2025 is also applicable this year for fiscal year 2026, or for those governments with effective periods beginning after June 15th, 2025. So fiscal year ended June 30, 26 would be the first year implementing this requirement. And so those two statements and the implementation guide, I will mention that there is an implementation guide for 26 on subsidies that's really near completion. That'll be available here supposedly in Q3. So that one should be considered. And we'll talk a little bit about that when we're talking about subsidies. So that's the overview. And you know, if you have the inclination to go on the GASB website, you know, their information, all of their issued standards, all of their current projects are there on their website, easy to find. They also have a discussion memorandum out right now, and they're looking for feedback on just GAAP. And you know, when you think about GAAP, there's really a dual authority. There's the original pronouncements, and then there's the codification. And so they're considering changing that to a single source authority rather than having this kind of dual equal authoritarian requirement. So there's that you could comment on. There's an infrastructure project that they're working on now that they're looking for comments on an exposure draft. So if you want to stay current on GASBs, that's a great location. GASB.org is the website. So let's go ahead and get started with this first section of GASB 103. So we're going to start off with an overview. You know, I like this slide because it kind of captures the essence of 103. As you may recall, 103 was kind of a big deal when it first came out. I was on the task force with GASB, and again, the task force doesn't make any decisions, so don't blame me for 103. I was just participating, but providing my perspective on the impacts of this evaluation of the reporting model. And in the beginning, the big focus, 80% of our focus really was on the governmental fund financial statements and maybe changing it from modified accrual to something other than modified accrual. And that's been taken out. So it's really taken a lot of the teeth out of this new standard, but there are things to consider. So I call these 6 areas, I kind of divide it in 2. I call the first 3 the big 3, because there's really 3 big changes from Statement 103. So 1, 2, and 3 are the big focal points of this standard, and I'm going to spend most of my time on the deep dive focusing on those 3 areas, and then we'll highlight the remaining 3 items. And it's not that they're not important; they're just not as widely applicable. And so we'll cover that. The 2025-1 implementation guide, and that's the 25 update, has 8 questions that provide clarification on GASB 103. And so I've incorporated those 8 questions into the discussion. As I mentioned earlier, the 26th implementation guide that focuses on subsidies, the exposure draft was issued earlier this year. Comments were due by April. I think they got a lot more comments than they were anticipating. And so currently that guide is slated to be issued in Q3, so in the next few months. We'll see if that happens. And then the guide has an effective date of actually 2020, affecting next year, so it'd be 2027. But if they're providing specific GAAP guidance on things that are applicable to how you characterize things, you don't want to implement 103 this year and then knowing that you have to change it next year. So be on the lookout for that implementation guide. So the first thing we want to cover here with 103 is the effective date. And a couple of things I want to call out here. One is it's effective for periods beginning after June 15th, 2025. So that'll be for those of you with a year end of June 30, 2026, so the end of this month, and after, you'll be required to implement Statement 103. The first thing I want to call out here is question 4.16 that was in the iGuide. component units with different fiscal years than the primary government. So it focused on whether or not, if you have a component unit that has, say, a December 31 year end, should that component unit implement in December 31, 2025, so that the primary government can incorporate those financial statements into fiscal year 26? And the answer is yes. So if you have component units that precede your fiscal year end, you should be communicating with them, making sure they're aware that you need their information in a GASB 103 compliant format. Okay, so that's pretty important. The second bullet I have on here is for comparative financial statements, and we get this question a lot. So I just really want to touch on it and highlight it, that for comparative financial statements, you need to restate not just the fiscal year under audit, but both fiscal years being presented in the basic financial statements. And so if you have a 2-year presentation, both years need to reflect the implementation of 103. So that's really important. Now, I'm not referring to, some governments present comparative totals. That's not really a comparative financial statement. There may be totals there of the previous year for comparison purposes, but the numbers aren't really presented in accordance with the basic financial statements requirements, meaning that maybe those prior year numbers aren't by fund. And the footnote disclosures may not have 2 full years of disclosure. So comparative financial statements are those with 2 full year presentations. So those should be restated for both fiscal years. The other thing that's really important here is in the transition paragraph, GASB talks about the fact that these changes are changes in accounting principles. Now, why that's important is GASB 100 provides guidance on changes in accounting principles, and specifically talking about how you should be restating the all periods presented. But in the RSI and SI, it talks about only restating the numbers that are presented in the basic financial statements. So what does that mean, say, for MD&A? Well, it means that if you present a single year financial statement for 2026, your 2025 comparative numbers in the MD&A should not be restated. And that's providing a little angst, because I think people want to change those previous numbers, so you're comparing apples to apples as you're analyzing the information presented, and not restating that may pose a problem. Not as much for primary governments, because you're presenting that condensed financial information on the government-wide basis, and it's really the proprietary fund financial statements that change, not the government-wide. Although I will say there may be some impacts on your statement of activities, because if you're changing your proprietary fund financial statement classifications, especially those between operating and non-operating, you may be impacting what you're reporting as charges for services, let's say, in your statement of activities versus contributions and grants that are either operating or capital related. So more about that. But anyways, those are the big changes on the effective date and transition. Overall, big picture, while you may not agree, GASB 103 modernizes government financial reporting, including improving its consistency and comparability among governments. I think that consistency is what they're really looking for. Clarified definitions. We now have a little better definition, especially regarding operating activities. More to come on that when we get to the proprietary fund financial statements. Impact on auditors and preparers. So, there will be more work for us as auditors in terms of, evaluating the changes made to implement 103. Certainly, those classifications between non-operating and operating, those presentations of subsidies versus other classifications, that'll be probably the bigger changes. But that's not all. I mean, there's other things to consider as it relates to your budgetary comparison information, as it relates to maybe your MD&A. So pretty significant impact on the financial statements and its presentation. And then just broader operational communication effects. You are going to have to communicate things probably to your stakeholders. Your governing bodies may need a little understanding of how these effects should be interpreted, because they may not understand the significance of how we've changed things into different classifications like subsidies. So that'll be pretty important. So let's jump into the details. So the first part of GASB 103 that we're going to cover is the proprietary fund financial statements. And I like to break things down into groups of three. And so if you look at GASB 103 as it relates to proprietary funds, I think there's three big changes that have occurred. The first one is the presentation. We talked a little bit about the presentation of the new statement of flows. So that's going to be a big change in how you present the financial data for essentially your income statement. And then definitions is the other big change. And there's two definitions to consider. One is operating versus non-operating revenues and expenses. And the other one is the definition of subsidies. So we're going to jump into that. Those are the three big changes. So the first one is the change in presentation. So you see the red arrows there. There's two big changes on this statement. The first being there's a new category, non-capital subsidies. And you can see there's a subtotal of operating income or loss and non-capital subsidies. So the goal here really is to, and not all governments are subsidized, but for those that are, this is a big deal because now you're going to show the operating income or loss after the subsidies are taken into consideration. So let's take an example of, say, a bus entity where their fare box recovery, the fares they collect from passengers may only represent 10 or 20% of their source revenues to cover the cost of operating those buses. And so they rely heavily as a public transportation on other sources of revenue. Here in California, there's the Transportation Development Act. Sales tax is kind of distributed throughout the state to provide public transportation. There's requirements there, so it may not be enough. So in addition to that sales tax component, there may be local government participation. But the idea is that they're collecting 80 to 90% of their costs, or recovering those costs through subsidies. And so they're always going to have a negative operating loss from operations because they weren't designed to recover their costs through operations. And so that non-capital subsidies category gives those governments that are subsidized a way to show their performance, if you will, or their condition after the subsidies. That's kind of an extreme example where you've got a very heavily subsidized operation. Not all operations are subsidized. Many are self-supporting. But you may have a program or a project with grant funding that's subsidized. And so maybe there's a subsidy coming in to support some specific element of your operations and not necessarily subsidizing the operations itself. So, but those clarifications are now a little more transparent as you're looking at the financial statements where you're including those non-capital subsidies and then subtotaling that. The other big change on this statement is the non-operating section. In the past, you'd separate capital contributions and transfers from other non-operating items. Now, everything outside of the non-capital subsidies will be captured in this other non-operating revenues and expenses section. So you can see, capital contributions, which is really the capital subsidies, those get moved up. And then the transfers in and out get moved up into one of the two categories, non-capital subsidies or other non-operating revenues and expenses. So some changes in presentation there. You'll notice the unusual or infrequent items, if applicable, would be at the very bottom of the statement of flows just before your changes in net position. And that's going to be consistent across all statement of flows, whether it's the statement of activities, whether it's the governmental funds, in this case, proprietary funds or fiduciary funds. Anytime you present those unusual or infrequent items, they're always going to be at the very bottom. So next, the second big item is definitions. And we're going to focus here on the definitions of operating revenues and expenses and non-operating revenues and expenses. So the first thing I want to say here is when you look at the definition for operating revenues and expenses, is all of those revenues and expenses other than non-operating. So it's kind of funny to have a definition, right, that is something that it's not. But GASB's intention here is they wanted to capture 100% of revenues and expenses, and they were concerned that if they defined what operating revenues and expenses were separately from non-operating, then you're going to have revenues and expenses that are undefined potentially. And so by defining everything being operating that doesn't meet the definition of one, the non-operating revenues and expenses, that means everything else is operating, okay? So that's a pretty big change, because right now it's really by policy, or in the past, really by policy, how you would define your operations and what you'd be considered operating revenues and expenses, and you'd include that in your significant accounting policies, how you determine that. And now really it's more defined. So this is the consistency that comes into play, where we talked about the improvements and the purpose of 103 from GASB's perspective is that this is going to improve consistency and comparability among governments, because everybody's working from the same set of definitions. So if operating is everything that isn't non-operating, let's focus in on what is non-operating then. So there's five items here: subsidies received and provided, and we're going to get into the definition of subsidies next. But subsidies is number one. Number two is contributions to permanent and term endowments. Now, I don't see that too often in kind of my practice. I imagine that's mostly higher education and maybe state organizations. But if you do have contributions coming out of the proprietary funds, this is going to stay in non-operating, which is probably where it's been in the past. Revenues and expenses related to financing, resources from the disposal of capital assets and inventory, and investment income and expenses. So those last three are very common. We see those kind of revenues and expenses related to financing. We see certainly bond interest expense or other debt interest expense. Revenues related to financing. So if you have interest earned on, say, leases, those should go here. We're going to talk a little bit more about that in a second. But these last three are very common, and we see these are pretty consistent with how most governments have treated these classifications in the past as non-operating. So I don't expect a big change there. Where I expect the change to be is really the subsidies. There was a clarifying question in the implementation guide for question 4.4, and revenue recognized from deferred inflow of resources related to leases are not related to financing. That's just a financing, not financial. Thus, they are operating revenues. So if you have leases under GASB 87 and you're leasing property, that property is recognized as revenue over the lease term, and that's revenue, operating revenue. The interest earned on those leases, the interest component, is considered a financing, and that is what would go in this non-operating section. So that's the clarification of 4.4. There is an exception, and the exception is you can classify as operating revenues and expenses if the transactions constitute the proprietary fund's principal ongoing operations. And here that's key. The example given is that interest earned, say, on loans for a first-time homebuyer program. That's really the purpose of the fund, is to provide loans to first-time homebuyers. Therefore, that interest revenue should be an operating revenue. Okay, that's the example given. So GASB provided a couple clarifying questions. The treatment of interest expenses associated with borrowings. And that really relates to 4.2, relates to a situation where you said, hey, I've got this first-time home buyer program. That's the purpose of my fund. I'm recognizing revenue on those loan interest. Should I also, if I have incurred debt to support that program, report that interest expense as an operating revenue? And the answer is no. The interest expense is related to financing. It's really not related to providing loans as a principal operation. So they're separate. So you would not include interest expense on debt as an operating expense, even though you may be including interest revenue as operating revenue related to that loan program. So GASB is separating that ongoing principal ongoing operation of a loan program, separating, the debt used to support and finance that operation. And the second clarifying question is interest revenue on leasing property. So if you said, hey, leasing property is my primary business, I know airports have a lot of leases, seaports have a lot of leases, governments may have a lot of leases in their proprietary funds. If you do, and that's the purpose of your fund is leasing property, then that lease revenue certainly is operating revenue, but the interest still does not qualify as operating, because the purpose is leasing property and the interest is financing. And so GASB is separating the concept of financing from that leasing of property as an ongoing purpose. So a couple clarifying questions there. The 4.1 on the right-hand side really has to do with cash flow statements. And in the example where the interest revenue is a operating revenue, if you get to the cash flow statement and you present that interest as part of the the interest component of the cash flow statement from investing activities on the cash flow, then you need to have this as a reconciling item in the operating indirect reconciliation, because it's going to be part of your operating net income or loss to get to your total operating activities. And so if you do have a situation where you reported interest or some revenue in the operating statement, yet you report on the direct method of the cash flows, you report it in a category other than operating, then it needs to be part of that reconciliation. Finally, I wanted to get to the subsidies. The subsidies, this is probably the most major change, I would say, of GASB 103, and really understanding what is the appropriate classification. And so resources received from another party or fund for which the proprietary fund does not provide goods or services should be a subsidy received. And the second part of that definition is it directly or indirectly keeps the proprietary fund's current or future fees and charges lower than they otherwise would be, meaning these are resources coming in and they're not going to have to be added to the ratepayers or whoever, whatever the main method of collecting your revenues are, your charges for services. So that's the definition of a subsidy. Now it could be capital or non-capital, but that's the resources received. For resources provided, it's money leaving the fund, right? It's money going to another party or fund for which the other party or fund does not provide goods or services to the proprietary fund, and they're recoverable through the fund's current or future pricing policies. So they're part of the revenues coming in, and those monies are going out to somebody that's not providing goods or services to the proprietary fund. So those are resources leaving the fund, and then all other transfers. So those are the activities. And this is probably the most controversial because a lot of governments are trying to figure out, where do I report these resources? Do they meet this definition or do they not? If they don't meet this definition, then most likely they're in operations because, the sources that you're providing are being provided to your proprietary fund or being provided from your proprietary fund. If it doesn't meet this category, and it's not a financing or investment income or gain or loss on sale, for instance, or disposition, then it's going to move up to operating. And so we have had several clients that have gone through this process. And what we are seeing is some changes where things were kind of being thrown into non-operating items because, quite frankly, they really weren't part of the ongoing principal operations. And so they were just being kind of put into other non-operating items. And now an evaluation of those sources and uses has to be made to determine, well, maybe some of these items should be moving up. We have had some clients that didn't look at leases as part of their ongoing operations. It wasn't a major part of it. And so they were just reporting leases, both interest and the revenue from the lease itself as non-operating because it really wasn't part of their activity or the purpose of their activity. It's more ancillary. And so those revenues got moved up, at least the revenue from the leases got moved up. They also had other things related to, say, escheat property or other kind of movement of funds that weren't really considered part of their principal operations, that they were just kind of putting into other non-operating items. So that would be the area I'd look at first. What is the nature of the items that you've been reporting in your non-operating items? That's kind of where you've mapped things to go. And you've got to evaluate, are they in the right spot, or do I need to move them up? And so that's kind of a big change. The other big change is transfers in and out. Now, transfers in and out most likely are subsidies, but you've got to determine whether or not they're capital or non-capital. And that really can't be determined by at the account line level, the trial balance level, if you will. You really got to look at it at the transactional level, because you may have multiple transfers in and out with different purposes and as budgeted, and some of that might be specifically for capital projects or capital purposes or financing, and some of it might just be supporting the operations of the fund. So that's time and effort that'll be needed. The initial implementation at the time of initial implementation, but then also most likely as some ongoing effort each year of evaluating those transactions on an annual basis. In addition, there were 3 GASB Q&A items addressing subsidies. Subsidies used for capital assets, but not limited to its use by the provider. So if the provider itself or laws and regulations, if the source of the funds aren't limiting those to capital assets, then most likely they're non-capital. That's kind of GASB's position, that really to be a capital subsidy, there has to be some kind of external requirement to use those funds for capital purposes. If you're making the decision internally to use those funds for a capital project, that's your own internal decision. That doesn't make it a capital subsidy. That would still be just a subsidy, a non-capital subsidy, because you chose to use it for your purposes in that manner. And so that's GASB's distinction there. So really, you need to do an evaluation of from the provider. Are you limited to its use for capital projects? There was a clarifying question on payment in lieu of taxes and whether or not those should be treated as subsidies or operating revenues or expenses. And the key driver there is whether or not they relate to providing goods or services. So if the fund is providing goods or services, or it's being provided to the fund, then they should be operating. And then the last one, 4.7, relates to third-party insurers. And this is probably very applicable to hospitals. And so GASB provided clarification that because the insurers themselves aren't the ones receiving the services directly from the proprietary fund, but there's a contractual relationship from the patient who is receiving the services, and therefore through that contractual relationship, the third-party insurer is covering those costs, and that's an operating revenue. So that seems to be pretty clear. What isn't clear is the exposure draft on the 2026 implementation guide characterized the Medicare program as being a non-capital subsidy because the government's supporting these healthcare treatment services and not specifically receiving those goods or services. And that's highly controversial. There's a lot of hospitals that have treated those revenues as operating revenues. They're very concerned about the impacts of that guidance. And so probably one of the reasons GASB got so many comments as it related to subsidies in this exposure draft is related to that question specifically, and the impact to hospitals that receive Medicare and Medicaid programs. And so more to come there, but there is no definitive answer on that. That's still in the exposure draft phase, and it's being deliberated. And until the guidance is finalized, after they consider all of the comments and all of that discussion, that'll dictate the next steps there. So be on the lookout for the implementation guide for subsidies once that's issued. Okay, budgetary comparison information. One of the next big three is budgetary comparison information. So there's three big things here to discuss. One is it's no longer optional to present it in the basic financial statement. So they should be presented as part of RSI for both the general fund and each major special revenue fund with legally adopted budgets, as RSI kind of following the note disclosures. Okay, so that's number one. So it's no longer optional. Most governments or many governments already have that RSI after the notes, and so not a big deal for them. They've already have a compliant presentation. The second big change is a new variance column. You now need to present a variance between the original and final budget amounts. That's a pretty significant change. And then the third big change is the explanation of significant variations between both the original and final budget and the final budget and actual results are now required. So three things to think about here. You might sense I like to explain things in groups of three. The first one is the general fund analysis in the MD&A may or may not be adequate based on what's being presented here with this new variance column. Number two, major special revenue funds, they may not have been included in your MD&A. So this might be the first time you're analyzing that MD&A. And then finally, the movement of these notes on your MD&A is going to be in the RSI, not the MD&A. And this
Dave,
is just
I'm sorry, I'm gonna have to interrupt you. I need to launch a poll and you have about 10 minutes left. So I just want to give you a rundown of your time, and I'm gonna launch a poll. It's gonna be, are you still there? Please answer that. And you can keep on going, Dave.
Okay, when you say 10 minutes left, I've got 9:40 at my time.
Yes, we wanted to leave any time for Q&A or anything like that. So if you want to run it all the way up, but yeah, that 19 minutes at the total.
Okay. Okay, notes to RSI. This is just what it's going to look like as a basic presentation. This is a GASB's illustration. So the polling question was just launched. The third big section of this of the standard is the MD&A. Now there's lots of changes here. I'm not going to walk through each of these bullets. There's a lot of them. I just provided that here for your benefit. But the overall essence is, we want to get rid of boilerplate language. They really need to be based on currently known facts, decisions, and conditions. And GASB is looking for the underlying cause of these changes, not just, a brush over of, taxes changed because sales tax went up 5%. Now they're looking for the underlying reasons as to why those changes have occurred. So that's really the critical aspects there. They would love to see charts and graphs, tables to encourage and enhance understandability, and really should be written in a way that somebody that's not a government professional can understand the information. It's really your opportunity to provide a story, the story of what changed for the year to maybe more of a lay person, rather than expecting them to kind of read through and understand your financial statements. GASB emphasizes that the MD&A is for the primary government. The focus should be on the primary government, but you can, as a matter of professional judgment, include information on discrete component units. Just make sure that when you do, that you distinguish that from the primary government. And this is the criteria. And this should look very familiar to what has been done in the past. You can see that they've listed the same 5 sections: overview, financial summary, the detailed analysis, significant capital asset, long-term financing activity, and currently known facts, decisions, conditions. So those are really very similar. So what are the highlighted changes? One is the condensed financial information should be consistent with the updates as it relates to changes in financial statements that we just talked about. Detailed analysis, really try and help the reader understand, what's changed and the underlying cause of those changes and the magnitude. It's emphasizing significant capital asset and long-term debt or long-term financing activity should include kind of those intangibles, and that's going to be re-emphasized with GASB 104. And you no longer should have budgetary information, or if you're on the modified approach for capital assets, you should no longer have that information in your MD&A. That moves to notes to RSI. The last three items of 103, these are what I call not the big three, but they are important to understand. So first of all, unusual or infrequent items has been simplified. Okay, so that's kind of nice to hear. You got something a little easier to implement if you're trying to use that. If you've used extraordinary items in the past or special items to kind of call out major events or major transactions, you had to meet both the criteria or some element of management's control and one of those two criteria. So now it just simplifies it. You just need to meet one of these two criteria: unusual nature or infrequent in occurrence. Definitions remain unchanged from statement 62. And the presentation should be at the bottom, the last item before the net change in either net position or fund balance. You should not be netting these items together. You should be showing each one individually, and then you should disclose the items. Obviously, if they're material enough to call out separately, then there should be disclosure about those items in your footnotes. Major component units. This is only applicable to those governments with multiple major component units where the financial statements may not be able to present all of the different major component units. So if you have multiple major component units, you should have another basic financial statement section after the fund statements that calls out those major component units. And just as a reminder, while major governmental funds and enterprise funds are defined quantitatively, major component units are defined qualitatively. So it's a matter of professional judgment what meets that definition. And then finally, in the statistical section, and this really relates to either standalone governments or basic or business type activities, because you've changed your proprietary fund financial statements, you really need to reflect those changes in the statistical section. Now, because you showed 10 years, you don't have to go back 10 years, but you should show the years in the basic financial statements at a minimum in this new format that we've been talking about for proprietary fund financial statements. So we're on to the third polling question.
Yep, I'll open this one up. You might see two open, but component unit poll 3 under GASB 103, when should a government present each major component unit separately in the basic financial statements? Always, regardless of impact and readability, only when the component unit is fiduciary in nature, when separate presentation does not reduce statement readability, or only in the statistical section. I'm gonna leave this open. I do want to say that it is when separate presentation does not reduce statement readability. Again, look at that bottom of the slide. They're on every slide if you have any trouble checking in or getting those polls. Dave, you keep on going.
Okay. All right, so now we're on to statement 104. This is a lot less of an impact and really is only focused on note disclosures. And so the new and modified guidance is that you want a separate disclosure of certain capital assets. And the big surprise, hint, is we're talking about intangible assets and disclosures on capital assets held for sale. So the effective date is this year for most governments, any fiscal years beginning after June 15th, 2025. And so what are you going to be disclosing really this is in that roll forward schedule that probably you're used to seeing for your capital assets. GASB wants you to separately list leased assets, intangible right to use assets by an operator for GASB 94, the triple Ps, public or public-private partnerships, subscription assets under 96, and other intangible assets. That might be water rights, it might be internally generated software, things of that nature. List those separately from your owned assets and do not combine them with your owned assets. And you should be listing those by major class. So for instance, for leases, you should be listing separately vehicles, buildings, equipment. You shouldn't be combining those together. Held for sale. A lot of governments have maybe land held for resale or redevelopment. That's not really the same thing. If you've been gathering properties and you've been accumulating those in an asset category, That's not what GASB is talking about here. They're talking about assets that are actually being held for sale, that the government has decided to pursue the sale, and it's probably that sale will be finalized within the year. So what are some of the factors to think about? Well, it's available for immediate sale in its present condition, actively looking for buyers, market conditions for selling that type of asset would dictate that it would sell within a year, and the regulatory approvals have been completed. So these are kinds of things to think about whether or not you have this situation. So if you do, you need to you're not going to relocate the capital asset or anything like that. It'll still continue to be reported with your other capital assets, but you want to disclose these assets, the carrying value of those assets, the any debt that's been pledged as collateral, and disclosure should be made for both governmental and business type activities. For the implementation guide, some things to think about here. So leases, conduit debt, a little clarification on 100 and 101, and then a couple other changes for title and special revenue funds have all been included in this 2025 implementation guide. So the leases really are just clarifications on lease term and when you would start treating lease modifications. For conduit debt, clarification on conduit debt issued by a component unit. And really that's for component units that issue on behalf of the primary government. It's really not a separate third party because it's a component unit of a primary government. So that should not be treated as conduit debt. For GASB 100, it talked about changes in capitalization threshold. That might impact you if you have capital assets and you change the threshold from say 5,000 to 25,000. That's not a change in accounting principles. It's just a matter of how you've determined materiality, and you should not restate your financial statements for that. You should flow those immaterial changes through. There's also some changes in there about how you present information in both the notes and the financial statements. GASB 101 had a clarification on future pay provision, like if you're getting pay increases in the future, but they're for a future date, you don't apply those future changes. And then there's a little clarification, if you will, on title and whether or not that equates to ownership. And there's a little guidance in there how you should determine that, because in some cases the title may be given to a conduit debt, but they wouldn't be, holding that asset. So there's a little clarification there. And the use of special revenue funds is not required unless there's two specific provisions. One is the general fund of a blended component unit should be treated as a special revenue fund. And sometimes laws, regulations, or contracts or agreements may stipulate that these funds are required to be kept in a separate fund, and that would be a special revenue fund if that's kind of the nature of the fund. So those are some clarifications in that guidance. The last GASB I wanted to cover was 105, and that's subsequent events, and not a lot of changes here. Really, it kind of gives some clarifications in terms of what qualifies as a subsequent event that should be recognized in the current year, or which should be recognized in a future year but disclosed. And maybe that key last bullet here is there should be a date through which the subsequent events have been evaluated. That date should be disclosed in the notes to the financial statements, and regardless of whether or not there's a recognized or non-recognized event. And so the effective date is for this upcoming year, for periods beginning after June 15th, 2026. So the definition of recognized events changes a little bit, but you want to make sure that the evidence of conditions that existed before the financial statement date has occurred if you're going to report it as an impact to the current financial statements. Okay, and the example here is like a bankruptcy. There's probably conditions giving rise to that bankruptcy that happened, prior to the actual event. Whereas a major casualty like a fire or flood would have occurred on that date. So a bankruptcy after the end of the year may dictate or may indicate that there was actually an issue by your reporting date. So you may have to treat that as a recognized event. So It does clarify that, recognized events require professional judgment based on the, facts and circumstances of those events. Non-recognized events, if it's whether or not it's favorable or unfavorable, should be recognized in the period in which they occurred. So if that event happened after the end of the year, it should be reported in that subsequent period. But because of the magnitude, it may be something that you would report in your disclosures in the current year. And so if that's the case, then you would add, information about that non-recognized event as a disclosure in your footnotes.
All right,
we've
let's
now
do that.
reached polling question number 4.
We did. Thank you so much. Let me open that up. So poll 4 under GASB 105, which of the following best describes a recognized subsequent event? An event occurring after year end that is disclosed only in the notes, an event that provides evidence about conditions that existed at the financial statement date, any significant event approved after the audit report date, or a debt-related transaction occurring after issuance. I'm going to leave this open. It is an event that provides evidence about conditions that existed at the financial statement date. I'll leave that poll open. Dave, back to you.
Okay. So being that we wanted to leave time for questions, and I'm not sure how many questions have accumulated, I will just quickly mention for GASB projects, there's 4 things that are kind of, going to be happening here pretty quickly. The first is we're going to see an exposure draft coming out for going concern uncertainties and severe financial stress. So that's going to be an exposure draft expected to be released in Q2 of 2027. So be on the lookout for that. The implementation guidance update for 26, that's already been released, at least the exposure draft has. Comments were due by the end of April. GASB is currently deliberating on those. They're expecting the final document to be issued here in Q3. So within the next 3 months, be on the lookout for that, because that may certainly have an impact on how you evaluated your subsidies. Infrastructure assets, you still have time to comment on that if you don't like it. Really, there's not a whole lot of changes there. It's just provides some clarification and definition of infrastructure networks and components and how you might evaluate and disclose that information. And if you use the modified approach, there's some significant changes there. So it's something to consider. Those comments are due at the end of this month on the 26th. And then finally, GASB's big project, revenue and expense recognition. And this is why I suspect that the governmental funds changing the modified accrual was not an ideal thing to do in the midst of evaluating revenues and expense recognition. So that exposure draft will be next year, Q3 of 2027. And then I listed out here a couple other projects that they have. They're looking at gap structure. We talked a little bit about that. Yeah, they've got other projects in the midst. And so so be on the lookout for that next set of projects. And with that, we'll open it up to questions.
I'm going to pass it over to Connor. And Dave, could you go one more slide for me for that eval?
Yep.
Thank you. All right, back to you, Connor.
All right. Thank you, David. Thanks for that insightful presentation. Unfortunately, we don't have time for questions, but we've